Hello wonderful traders, welcome to lesson 6 of this online forex course. My name is Emeka from FX, and while watching this video, if you find anything confusing, kindly pause the video and drop your question on the comment section, and I'll be there and I'll be glad to assist on your questions. So let's dive into it. So guys, in today's lesson we are going to be talking about position sizing, risk management, and how to automate trading with others. So the first is how to size your position in order to manage your risk, and also how to automate your trading so that you can trade with less effort, so that you don't always have to be with your trade to close it on profit or how to close it while on loss. So now let's start with position sizing. So now guys, position sizing is that part of your trading system that tells you how many contracts to buy or sell per trade. Now, as you know, every trading system doesn't take into account the entry rules and the exit rules. Now, I know some people might say, yes, I know when to enter and when to exit the market. But if you don't size your position correctly, you will be struggling to achieve your expectancy in the long run. So if you recall on our previous lesson, what makes a successful trader? There are 3 things to take into account. You've got, first of all, your trading strategy. Then you talk about the position sizing, and then the last and the most important part is your trading psychology. So your trading strategy comprises of 10% of what makes you a successful trader. Your position sizing, which is what I'm about to teach you now, is what comprises of 30% of what makes you a successful trader. And the most important one is the psychology behind every trading strategy and every position sizing. So now on position sizing will help you to determine, number 1, how many contracts to go long or to go short for a particular trade. Now the second one is your risk per trade and overall risk to your portfolio. Now the last is your expected return to your portfolio in a short or in a long run. So next, let's go to steps in calculating position sizing. So the first thing to put into consideration is to check your net liquidation, your capital. So whatever broker you are using, once you log in, you can be able to look at your overall capital. So for instance, let's say you have $10,000 in your balance. You open your account, you saw $10,000. That is what you call your net liquidation. Now the second step is that you must be able to determine your risk per trade. Like I said before in the previous lesson, I will recommend something like 1% or 2% for a start. So again, the risk I'm talking about, it refers to the maximum loss you are willing to take per trade, per single trade. And as you know, this is the maximum you can lose if your stop loss get hit. Now, like I said, and I keep saying it, your loss should never be more than 1% to 3% at maximum of your total capital, of your total net liquidation. So another thing to put into consideration is that once you decide your risk per trade, it is advisable to stick to that risk. Don't risk 1% today, then risk 2% tomorrow, or risk 3% tomorrow. If you decide to start risking 1% of your capital while trading, stick to it. If 2% is okay to you, stick to it. If that's 3%, stick to it, but don't switch between 1 to 3%. If you decide on what you're gonna be risking per trade, just stick to it. Because what a lot of people do is that they look at a trade setup and they say, wow, I'm very confident with this trade, so I'm gonna risk 3% on it. I don't feel so comfortable with this trade, so I'm gonna risk 1% with it. Now there is no trade that is 100% win rate. There is no trade that comes with 100% guarantee that you're gonna win the trade. So the good and the bad setups, make sure to always use the same risk per trade as the previous trades. So now let's take example of where we start risking by 1%. So once you have that, the next thing to do is to calculate your position sizing per trade. So now I'm gonna show you how to calculate it manually, but in reality there are many position sizing calculator that I'm still gonna show you in previous lessons, which you can download on your phone or your mobile phone, or you can go through the website. So the purpose of me teaching you that is for you to understand the theory behind that calculation that you get through your mobile phone. So now here on my screen is the formula. It means that the number of lots is equals to net liquidation times percentage risk per trade, and divided by your stop loss distance times value of pip. Now again, remember that I told you that different currency pair have different pip value. So this pip value depends upon the kind of the currency pair you are trading. So the practical example is what I just showed you now on my screen. Let's say your net liquidation is $10,000 and your risk per trade, of course, is 1%. Your stop loss distance is 20%. And then, for instance, we are trading Euro USD and you know that the value per pip for Euro USD per standard lot is $10. So now next, and still on determining your position sizing. Now let's take a look at another example. So now the first step is to determine your account equity, like I said before. So again, in this case, we are going to assume that we have a $10,000 worth of equity. And then again, the second step is to determine your risk per trade. So now in this example, let's say you have more confidence in your trading system and then you want to risk 3% of your capital. And again, once you felt confidence in your strategy and you've upgraded to 3%, you cannot go back to 1%. When you choose 3%, you stick to it. So this simply means that in a losing trade, when the trade hits your stop loss, you are prepared to lose 3% of your capital, which is 300. Now the next step is to determine your stop loss distance. Now in determining your stop loss distance, this depends solely upon your strategy, your trading strategy. So now, example, let's assume your stop loss is 30 pip away from the entry point. So the next one is calculating the number of lots per trade. So now number of lots will be equals to net liquidation times percentage risk per trade divided by stop loss distance times dollar value per pip. So again, dollar value per pip, it depends on the currency pair. Euro USD have a $10 worth of pip per standard lot. Now on other currency pair, it could be slightly more than 10 or it could be slightly less than 10. It could be 9, it could be 11, it could be 12, it could be 8. So on the previous lesson, I showed you how to determine the dollar value per pip for each currency pair. Now for more simplicity, we are going to be trading Euro USD, and right there on my screen is the example of the trade we are taking on Euro USD with 3% risk per trade. So now next, and still on how to determine your position sizing. Now a few important points to know. Now, regardless of where you place your stop loss, it doesn't matter if you place your stop loss at 10 pips away, 30 pips away, or even 200 pips away, your risk should always remain the same. So regardless of where you place your stop loss, it should not change your risk per trade. So to do this, you always have to determine your stop loss level first. You have to always determine your stop loss first, then you can be able to calculate the number of lots you want to place per trade. So what this means is that the number of lots traded is inversely proportional to the stop loss. So in other words, the farther your stop loss, the smaller the number of lots you want to trade with. The nearer your stop loss, the greater the number of lots you are trading with. Alright, next, this is the website that I use to calculate my position sizing. Now on this website, all you have to do is to place your account balance, place the risk, the number of risk you wish to trade with, place your stop loss pip, choose the currency pair, and then it will calculate and tell you the number of lots to use on that particular trade. So this will help you to maintain the same risk per trade in every given trade. So now this is the website to use to calculate your risk and your position size. I think I've shown this website on our previous lesson. But personally, I use the one I downloaded on my smartphone. You can get, there is a lot of Forex calculator on your Android phone. If you are using an Android phone, you can download it on your Play Store, and if you are using an Apple phone, you can go to your App Store and download it. So there is a lot of Forex calculator out there that can help you to calculate your position sizing. So now I'm gonna give you a real life example of how to work your way around this position sizing calculator. So for this example, we are going to assume that we have a $10,000 worth of account size. Then the next thing we are going to put is our risk that we are going to use for this trade. In this case, we are going to assume we are risking 3%. Then your stop loss is like 30 pips away. Then choose the currency that you want to calculate with. In this case, we are going to use Euro USD. Then click on calculate, and boom, you see all your results and what you should risk per trade. Now as you can see, we are supposed to risk one standard lot on this trade. So next, let's take a look at a graphical representation of what risk management and position sizing looks like. So now when you look at the left, you will see a long trade, a buy trade, when you are entering at a certain level. So for instance, you are entering at 1.2020. So in this case again, you place your stop loss 10 pips away. So now it's 1.2010 because it's 10 pips. Now this stop loss represents your 1 hour distance. Remember when I teach you about risk and reward, you risk 1 to gain 1.5 hour. So if our stop loss is 10 pip, that means that 1.5 hour of 10 pip is 15 pips. So our take profit level should be 15 pips. And in this case, it should look something like 1.2035. So now on your right hand side of the screen is a different trade, but your stop loss is now 20 pips. So 1.5 hour of 20 pips is 30 pips. So your take profit should be 30 pips above the entry price. So now again, no matter where you place your stop loss, your risk per trade remains the same. You should always remember that. So next, and again, let's review our rules one more time. Now the essence of risk management is that it ensures that you keep your losses small and you will always have enough equity to keep trading on an event of a losing streak. Now losses is part of forex trading, it's part of the game and it's inevitable. You cannot avoid having some series of losses while trading. So if you manage your risk very well, there comes a time when you have some series of losing streaks. You have 5 losses in a row. If you don't manage your risk very well, 5 losses in a row, your capital is gone. But when you manage your risk very well, 5 losses in a row, for instance, if you are risking 1% per trade, even if you have 5 losses in a row, just 5% drawdown from your capital, and it doesn't hurt your feelings, it doesn't affect your trading psychology. You will keep trading on the next day, because after a series of losing streaks, what comes next is winning streaks. So here is the rule we talked about before. Now remember to always risk a fixed percentage of your capital. I will recommend 1% and not more than 3% per trade. So now, like I said before, if you are risking 1% of your capital and you have like 4 losses in a row, it's just 4% drawdown from your capital. And if you are risking 3% per trade, it's just 4 losses in a row, you will have like 12% drawdown from capital. But if you risk 10% of your capital, which you should never do, if you have 4 losses in a row, that's 40% drawdown, and immediately you have this, it will start affecting your trading psychology. So again, always remember to use stop loss order. Never place any trade without a stop loss, because the stop loss level is what allows us to determine the amount of loss we have or we should have in a certain trade. So because the difference between an amateur trader and a professional trader is that when a beginner trader enters the market, the first thing he thinks about is how much money he's going to make in that trade. He doesn't think about losses. And to me, this is a gambling mentality. But professional traders, before they enter any trade, they always think about how much am I willing to lose in this trade, because they know that each and every single trade they place comes with the possibility of loss. Another thing now is to always use a take profit order, because this allows us to predetermine the profit in a case of a winning trade. Now remember, you can always make money at the end of the day if only your average win is more than your average loss. Now you cannot control your win rate. It's not possible to control your win rate, but you can always control how much you win when you win and how much you lose when you lose. And by so doing, you make sure that you have a consistent profit at the end of the day. So again, about the risk reward ratio, always ensure that your risk return ratio is at least 1:1.5 R in the example that I gave you. Now by doing this, trading success will always balance the win rate and the risk return ratio. Now next, and few other important rules. So this is my style and this is the way I trade. I don't take 2 concurrent trades at a time. Now what do I mean? If I go long on Euro USD, I cannot go short on USD JPY, because going long on Euro USD means I'm selling USD. Now going short again on USD JPY is like repeating the same trade again, because obviously you are selling USD in 2 different trades. So I don't do that. This is my style. It doesn't always have to apply to you, but this is the way I run my trade. Now again, what I usually do is that I take a maximum of 3 trades per day. Now, it doesn't mean that if I see more positions or more opportunities that I won't take, but this is after years of trading. This is what I discovered about my trading style and my trading strategy. I don't take more than 3 trades per day. Now, this is based on this particular strategy that I'm about to teach you. So now this is the maximum. Now, there is no minimum. There is a day that I won't see any trade set up in the market. I won't take trade that day. It's not compulsory to always take a trade every day. Whenever you can't find any clear setup in the market, you're based on your strategy, then don't trade. Now next, so now that you understand how much of risk you are taking while taking a trade, the next thing we have to learn is how much we can potentially earn as a professional trader. So to do this, we have to determine what is the expectancy of our trading system, your trading style or strategy. Now again, whatever trading strategy you choose, it must have a positive expectancy in the market. Now again, like I said on the previous lesson, this is the right there on my screen is the formula to calculate the expectancy of your trade, of your trading system and your trading strategy. So let's take an example. Now let's imagine you risk 1% per trade, and 1% of $10,000 is $100. So it means you are risking $100 per trade. So your average loss should be $100. And then your average win should be 1.5% times 10,000, which is $150. Because you are risking 1 to make 1.5. So when you do the math based on your win rate, you see that your profit expectancy is 55%, and that is $150. So now it means that for every trade, for every single trade that you risk $100 in it, it means that you are making an average of 37.5% per trade. So this means that if you do 20 trades per month, which is the minimum that I see, I've never taken less than 20 trades per day, but this is the minimum, and let's just assume, let's use it on this example, that you made it just a total number of 20 trades per month times 37.5. that will give you on average a $750 in profit. So that means on average you are making 7.5% per month with your $10,000 capital. Now this is an average, and if you compound this in 1 year, it means it's 100% of your capital in 1 year. And remember, this is when you are risking 1% of your capital, just 1%. It multiplies when you risk 2 to 3% of your capital. Now to add to that, you should also note that your capital is not always 10,000. Remember that when you make profit and while risking the next trade, you compound your profit. Because when you make up to like 15,000 in profit, your capital is no longer 10,000, your capital is now 15,000. So while risking even 1% of 15,000, you don't expect to get the same profit you get while trading with $10,000 worth of capital. And this brings us to the end of today's lesson. If you have any question, kindly drop it down at the comment section and I'll be there to assist you.